Hello, everyone. I see that people are starting to come into the presentation. Definitely appreciate everybody for joining us for the Money Show Investing in Alternatives Virtual Expo. Our speaker is here and she is ready to bring the insights. So we'll have an on-time start at 10:05. If you have any questions, feel free to leave them in the chat and we will monitor them as we go. Hello, everyone, and welcome to our next presentation of the Investing in Alternatives Virtual Expo. We have speaker Ina Rasputnia next. Ina Rasputnia is a professional trader, quantitative strategist, and CEO of ManagedAccountsIR.com, where she runs automated trading systems powered by proprietary quantitative models. Her approach combines algorithmic precision with deep market structure insight, targeting opportunities in stock, index, and futures markets. Ms. Rasputnia is the author of Basic Instinct of Trader, a practical guide to building mental discipline and a tactical edge in the markets. Ina's insights have been featured in BenzingaEquities.com, Investing.com, and the Business Women Media. Her leadership in finance has earned her multiple global awards, including leading an innovator in wealth management and most outstanding woman in finance. Without further ado, please welcome Miss Ina Rasputnia. Ina, the floor is yours.
Thank you very much for the introduction, and thank you very much to all for coming to see my today's presentation. So today we're going to be talking about how AI and systematic trading are reshaping alternative investing, and I will show you a few facts that I believe will surprise everyone. So let's get started. It's not a secret that investing has entered a new era. Traditional portfolios face increasing challenges, and it's quite normal for the markets because the markets are always developing, they are always changing. So what challenges our traditional portfolios facing? First of all, it's higher volatility. Nowadays, the markets are way more volatile than they were, for example, even 20 years ago. Higher correlation between stocks and bonds during inflationary periods, and not only inflationary. I would say any kind of black swan event like COVID, for example. Faster market reactions. As markets become more and more volatile, the market reaction and the traders' reactions should be much faster. AI and quantitative modeling is transforming investment research, execution, and risk management. And it's not that bad. And why? We will talk now about it. But first, let's get started with the correlation between stocks and bonds. You can see that this chart that previously we had a negative correlation, and it worked perfectly for 40-60 portfolio and for the classic type of investing. But in the recent up to 5 years, the situation has changed a lot, and the correlation between stocks and bonds became positive. which just ruins the traditional investing and ruins traditional diversification into different asset classes. But there is always, if one door gets closed, there is always another door that opens. But we have to be very focused to see that another door. So what do I mean by that? I'm talking about managed futures, and you can see this chart. The dark blue lines are a traditional 60-40 basket, and the light blue is CTA index. You can see that they don't have any correlation at all, which makes managed futures a perfect fit to any investor who wants to have the well-diversified and uncorrelated portfolio. More than that, you can notice that those two assets are not only non-correlated, but the CTA index hedges very well portfolio during the major stock market declines, like it happened here, for example, and here, but we will talk about it in more details in a little bit. As for now, this chart clearly proves that CTA index and managed futures are just perfect for diversification nowadays. So why traditional investing isn't enough? As I mentioned, by traditional portfolio, I mean stocks, bonds, and real estate. Real estate is quite a different kind of investment because of its low liquidity. And especially if we see some economic downturn, it becomes highly illiquid investments. But what about alternative investments such as hedge funds, managed futures? First of all, they offer very good diversification, and the chart that we had just looked at proves it. It gives uncorrelated returns, which is also a big plus, especially in economic downturns. It has very good liquidity. And it offers great transparency because unlike mutual funds, the money is always on your account and you can see exactly what is traded and how it's traded. Sometimes with mutual funds, you can also get into some kind of trouble or negative surprise when you realize what kind of instruments they are trading. And also, if you're comparing to mutual funds, of course, managed futures offer the way better returns than mutual funds. So what do investors want? And can managed futures offer that? First of all, global diversification. Of course, with managed futures, you can trade different global markets, and all those global markets absolutely uncorrelated. For example, energy sector, German stock index, wheat, sugar, absolutely different kind of market that are not correlated at all. Managed futures offer very high liquidity and transparency, as I mentioned. And what is most important, those markets are completely regulated, and moreover, they offer an opportunity to gain profits in both cases, upside markets and downside markets. This is very important, especially for those who are looking protection for downturns in economy or in different asset classes. Another chart represents equities and managed futures correlation. The orange line is is S&P 500 index, and the blue line is Barclays CTA index. Again, from this chart, you can double check and confirm that these two assets are completely uncorrelated. And here is probably one of the most important charts, equity drawdowns of 15% or worse since January 1980. and what happened to managed futures during this downturn. So what we have to yellow line is S&P 500, and the green line is Barclays CTA index. You can see few downturns in the market like it happened here, and managed futures went up. They offered not only great diversification for investors, but also an opportunity to gain profits during the turbulent times in the stock market. Here is another example of stock market downturn, and you can notice that managed futures profited a lot during this period. Again, we have another slight decline here. Not much is happening in managed futures, mostly flat. And another example, another downturn during COVID, and managed futures remain with a very strong performance. Again, another example of downturn here. And during this period, we see that managed futures rally significantly. So this chart confirms that managed futures as alternative investment offer great diversification and also offer great income, passive income for investors. So the fair question next would be, what are systematic futures and how they can help investors to profit more and to protect from undesired events in economy? First of all, if I had only few words to say about systematic futures, those words would be rule-based, diversified, uncorrelated. Systematic future strategies are quantitative models to identify trading opportunities across different global markets and different time frames. The most important thing about systematic models is that they are rule-based signals that identify trades and trends. They also have an advanced risk management, by which I mean portfolio sizing, diversification, and a loss control. Also, systematic futures seek an opportunity to gain in downsides, on downside as well as on upside. And as I mentioned before, they cover very wide range of markets, including equity indices, interest rates, different type of commodities from precious metals to energy and agriculture, different types of currency futures and sector indices. But what is the most important for each investor is to remember key characteristic of systematic futures. First of all, they are rule-based. Decisions are based on data and rules. No opinions, no emotions at all. Everything is driven by data and rules. They trade a wide range of markets, as I mentioned, and they seek opportunities in rising and falling markets. They are risk controlled. Strict risk management aims to protect capital as well as to manage drawdowns. And they capture short-term, medium-term, and long-term trends in the market. But again, as I mentioned, the most important for us to remember now is they are rule-based and data-based. No opinions, no biases, and no emotions. We often hear talks about human versus AI trading. So let's have a look into it. First of all, each of these options has its pros and cons. Human understands macro events, while AI can process huge data sets. Human recognizes regime shifts, and AI finds hidden patterns. Human adapts creatively, AI executes constantly. Human is emotional, and AI is emotionless. So what do we have if we combine the best from human and the best from AI? We have the brain, let's call it, so the hybrid model that understands macro and that has an advanced pattern recognition that takes just a milliseconds. We have an experience combined with millions of calculation within seconds. We have adaptability and consistency. We have understanding of market context and speed of execution. You could hear a lot of talks about how advanced AI is, but as an experienced trader and quantitative model developer, I can tell you that AI can be quite good in entering the trades. That's true, but it's just terrible at closing the trades. It's true also. It's not even close to what human can do. I mean, closing the trades. So while AI can help a lot in pattern recognition and modeling, and it saves a lot of time, it also avoids the situation when human eye and brain can miss some important information, and it helps a lot to save time. It helps to do more precise research, but the final decision should always be human, because AI is not at their stage where it can do better decisions than human. Maybe in 100 years or in 50 years it will be so, but nowadays the reality is different. Nowadays, neither wins alone. The hybrid is what wins. The combination of the best of two worlds combined together is what really gives an advantage in the market nowadays. There are a few myths about AI trading. The first one is AI predicts the market. But it's not true. The reality is AI estimates probabilities. It works only with the probabilities, identifying the better probability in the market potentially and advising it to the trader. Another myth is AI never loses. Oh, that's so not true. Without human control, it can make terrible losses. If it trades, if it does research, it will do it on the best level. The reality is risk management matters more. No matter if we are talking about AI trading, about human trading, or about combination of hybrid trading, and the risk management is what stands above everything. And when I am talking about combination of human and AI, by human, I mean an experienced trader with strong instincts in the market. I am not talking about the operator that just watches if algo is on or off. That's very important to remember that. The myth is automation removes human. But it's not true. Again, as I mentioned, professionals supervise every model. And the best decision comes when we work with the data that we got from AI or quantitative modeling, and we make a human decision, because as the human, we have better understanding of macro, of trend shifts, and so on. So how do professionals build trading system? Everything starts with an idea generation. It can be market insight, research, and so on. The next what professionals do is research and data analysis. We explore data, economic logic, and edge potential. We do back testing, test rules on historical data. The next what professionals do, and our retailers never do that, is stress testing. We evaluate in extreme market condition and across different regimes. Walk forward testing, test in real time with rolling out of sample periods. The next goes paper trading, live simulation to validate execution and operations. Then we have production deployment, gradual capital deployment with strict risk limits. And only after that, monitoring and continuous improvement, ongoing performance attribution, risk monitoring, and refinement. As you can see, there's a long period and a lot of work till idea becomes an actionable trading strategy and an actionable trade. It has to pass through all these stages. As a result, less than 1% of ideas actually reach their production. Why most trading systems fail? Markets are efficient, edges are fragile. Discipline separates signal from noise. Common reason systems fail include overfitting. Models capture noise instead of true signal. Curve fitting, other optimized parameters that don't generalize. Ignoring cost, transaction cost, slippage, and fees returns, erode returns, it's very especially important section for scalpers and for scalping trading strategies. Excessive leverage, too much risk leads to large drawdowns and blowups. Poor risk management, inadequate position sizing, no stop loss logic, no portfolio controls. Regime changes, strategies that work in one regime fail in another. And for this reason, it's especially important to combine the best from AI and the best from human. It helps to create the most strong systems that don't fail because of these reasons. No matter how good AI is at data processing, AI has its limits in trading. It's a powerful tool, no doubt about that, but it's not a silver bullet. AI can enhance investing, but it cannot replace human judgment, adaptability, and risk management. First of all, AI is highly data dependent. AI is only good as the data it's retained on. It makes no sense and no use if data is not enough. No context or common sense. AI lacks human intuition, real-world understanding, and the ability to grasp complex context. It struggles with novel situations. AI performs well in the past. It struggles with the new unexpected events and regime shifts. And this is exactly the case when human decision-making is so important. At the same time, it has no emotional intelligence. AI can't emphasize, build trust, or understand human behavior and sentiment, while an experienced trader has such ability. Black box risk. Many AI models lack transparency, making it difficult to explain or trust the decision making. Model risk and our reliance. Overfitting, outdated models, and blind reliance on AI can lead to significant losses. What AI can't replace? It can't replace human judgment and experience, adaptability in uncertain environments, ethical decision-making, accountability, and responsibility. So the key summary and key takeaway, AI is a force multiplier, not a substitute. The best results come from combining AI's computational power with human insight, discipline, and adaptive risk management. Risk is a product. Risk is not just about how much you lose. It's a combination of what you lose, how often, and for how long. In trading, risk is not a single number. It's the product of three critical dimensions. Two strategies can have the same average loss, but very different depending on frequency and duration. And that's why we will get absolutely different results on those strategies. So what are the three most important components? Severity, how much you lose when you are wrong. Larger losses hurt more, no doubt. Capital at risk per trade position sizing is crucial, is very important here. This severity we can control with position sizing, stops, and daily risk limits. Frequency, how often losses occur. More frequent losses compound to damage, as well as frequent gains compound to profits. Often driven by overtrading or weak edge. It can be controlled by high quality setups, discipline, and trade filters. Duration, how long you stay in a losing trade or drawdown. Larger drawdowns increase emotional and financial pain. Opportunity cost increases a lot. It can be controlled with time-based exits, stop management, and patience. So modifying only one of these three components, you can change your overall performance by a lot. If you modify at least two of these three components, it will change even more. That's why it's so important. And when it comes to systematic futures, risk comes number one, not actual trade ideas, not actual execution. So how do institutional investors adopt managed futures? You can see this chart that shows how popular managed futures have become in the recent few years. Each year, they are more and more popular among institutions. The next chart shows the period for the recent 5 years and what happened to portfolio if you add managed futures. Managed futures are marked as dark green here. So here, the first one, we don't have any managed futures. It represents the lower return. The next one, 5% of total portfolio are given to the managed futures, and we have higher return. And it goes on and on till we increase, for example, to 20%. And we get the highest possible return by adding managed futures only by 20% to our diversified portfolio. This chart shows a lot and it tells more than any words can tell. So what is the future? I believe that AI enhances human decision making. The prediction is less important than the process, and we can ignore prediction completely. Our job is to look for and identify best trading opportunities in the market and take them. Prediction is not a job. It's not a trader's job. It's not an analyst's job. It's just something that creates undesirable bias in the market. Risk management creates longevity. Diversification is essential, and hybrid intelligence is the future. Combination of the best of human and artificial intelligence create just the best performance strategies. So the key takeaways today, AI is a tool, not a replacement for the experience. Systematic investing is about discipline, not about prediction. Risk management drives long-term success. Diversification matters more than ever. Hybrid intelligence is likely the future of professional investing, and we are standing on the early stages of it right now. And in the end, I would like to make a short summary. The future of investing isn't human versus AI. It's human judgment enhanced by AI, disciplined by systematic rules, and protected by risk management. Thank you, everyone. If you want to learn more about my work and about my trading, you can visit my website. And we have a few minutes left to answer the questions if we have any.
Yes, it does look like we have one question. Someone asked, you emphasized that AI is most effective with human guidance. In your experience, what investment decisions should always involve human judgment, even when AI provides a strong recommendation?
Yeah, I would say so. AI should be used just to identify very quickly the best opportunities in the market, to analyze a lot of data. But the human decision is always final, and it's more important because AI doesn't understand macro picture or maybe something that happened on the market, some news, and AI doesn't understand how people will react on it. And that's why the data and the decision that AI is advising to you can be wrong. And you as human, you understand that AI has came to this conclusion analyzing a lot of historical data, but you have to put this result into context you have now in the market. So your decision, I would say, yes, it's more important than AI.
Awesome. And then we have one more question. How do CTA strategies typically perform during bear markets compared to traditional equity investments?
I have shared I have shared the chart recently, if I can find it quickly. It performs a lot better. Let me come back to it. Here you can see the data when we have a stock market, for example, here falling above 40%. The managed futures gained at the same time about 20%. So in total, it's above 60% difference in the results. And here is another example for the stock market declined 20% and managed futures rallied almost 40%. So in total, it's also almost 60% difference. So you can pause the video later, it will be recorded, and you can pause it and to check all the data from this chart. It gives the real numbers from the history we have.
Perfect. Well, thank you for sharing. That is all the time that we have today. That was a great presentation. Definitely appreciate your time. Um, if you all have any questions for Ina, again, be sure to drop them in the chat. And if you do need to contact her, she provided her information, her contact info as well. So make sure that you contact her directly. Our next presentation will start at 10:40. So hopefully you all are interested in moving on to the next presentation. And we look forward to having you join us for the rest of the day. Thank you, Ina.
Thank you, everyone, for coming. And thank you, Manisha, for having me again. It's always a pleasure to be here.
Absolutely. Thank you.